How does a storage facility get evaluated?
Yeah, it's a good question. And it's a real simple formula that, of course, as you dive into it, we can go deeper. But for our purposes today, I'll describe it this way. All we're going to do is take the income that the facility is currently generating, subtract out the current expenses, and now we're going to get an existing net operating income. So really that's cash flow, except you're not including debt service in that calculation. So it's as if you bought a rental house, all cash. What would your cash flow be annually? That's your net operating income. And then we're going to multiply that by a multiple. That's a bad way to describe it. Or we're going to divide it by a cap rate. Generally speaking, storage facilities are going to be worth somewhere between, let's say, in this market, it's tough, but generally speaking, when I started in this industry, if we were looking to buy properties at a 10 cap, and it happened with relative frequency, it doesn't anymore. To your point, to find an 8 cap is hard. What an 8 cap means is the property is valued at 12.5 times that net operating income. So you take the NOI, divide by the cap rate, and that will get you a value. Generally speaking, we're trying to buy between 8 and 10 right now if we can. But I will say, especially when we're talking about these extreme value add properties, cap rate falls apart as soon as you do the math, because they're half full, they're a quarter full. And in many instances, you run that formula and all of a sudden they have to pay you to take the property, which we know they're not going to do. Right. And so what we do is we look at the stabilized value of the property. What will it generate when we're running it the way it should be run? What will our expected expenses be? Now we have an NOI. We use the cap rate formula based on what we know about that market. It could be anywhere. In the properties I invest in, we're going to sell them between a 7 and an 8.5 cap rate. In larger markets, big cities, it might be a 5 or a 6 cap rate. If Class A properties, multi-story with elevators, like that type of thing. But we're gonna use that to get our basically as stabilized value, and then we're going to reverse engineer. Okay, what can we offer? Oftentimes in the rehabbing world, that's your max allowable offer. You know, it's the after repair value times 70% minus whatever you got to do, you know, your expenses, and you build in that profit margin. We're doing the same thing. I try to get as close to doubling the value of the property as I can.
Thanks for listening to the Virtual Real Estate Investing Podcast, presented by Greyline Investments, where we talk about how to find, fund, and finish deals from anywhere in the world.